So page 82, we're going to talk about business organizations tonight. And I'm going to start with this chart here. This is a chart that I put together several years ago. I was teaching a class over in Salem for the Economic Development Commission for small business owners. And so I'm not going to go through everything on here. I'm primarily interested in the first two rows here, that you're aware of what those are all about. But essentially what we're going to talk about is when you're setting up a business, what are the various different factors that you want to consider when you're deciding which of these formats of business organizations that you want to use. And so I have the various different factors here, including liability protections, what are the tax issues involved with the different organizational types, what are the formalities that are required to set up the business, what sort of financing is available in terms of obtaining investors and equity investments and that kind of thing. How will the business be managed? How long will the business exist? Will it go away when somebody dies, or will it be in perpetuity like a corporation? And liquidity is how easy is it to get out of it if you want to sell. I'm not really going to focus on pretty much everything, but this first two is really what I want to focus on. Formalities, I don't really get into that too much in this class because we have another class here at Western where that's pretty much all we do. It's an entrepreneurship class that I teach where we actually set up a business. So I'm going to focus on these two for this class. Now for the final, I want you, in terms of fill in the blank question, I want you to be able to list 4 of these 7 factors as a fill in the blank. That's why I have list 4 right here. And I also want you to be able to list 4 types of the different business organizations that we have along this top line. So the first we have is a sole proprietorship and a general partnership are the first 2 basic types of business organizations. I've written the word default there. And what I want you to know about a sole proprietorship is the most basic form of a business organizational type. It's really not even an organization, it's just you. And if you're a single owner, one person business owner, and you're not otherwise organized as one of the other organizational types, you're automatically characterized as a sole proprietorship. So that's what I mean by the default, is that you're by default considered to be a sole proprietorship. And it's basically the most simple type of business organization. It does have some advantages in that it's simple, but it has some major disadvantages in terms of liability protection, which there isn't any. And I'll go into that more in a minute. The next type of structure is a general partnership. And a general partnership, again, is the default when you have 2 or more people that are engaging in business activity together. So if you're not organized as one of these other structures, you will automatically be deemed to be a general partnership. Now, general partnerships have a lot of problems with them. Primarily, there's no liability protections, which I'll show you more in a minute. And so they're really not a favored way if you're going to be an ongoing business as a general partnership. So it's in the real world, we typically are going to trend towards LLCs and S Corp and C Corps, primarily in small business, LLCs and S Corps. And I'll get to those here in a few minutes. So for right now, the 2 most basic types of business structures are sole proprietorship and general partnerships. They're the default. And then we get into the other ones, and I'll detail those out more in a minute. So the first thing I want to talk about is this liability factor. So when we talk about factors that you're using to determine what business structure you want, one of the big issues in business is the potential for liability as a result of, I'm going to flip back a page to 81. When we talk about liability issues, what we're talking about is potential problems that may arise out of your business. And that could be something where you have an employee that hurts somebody on the job, maybe a delivery driver that runs over somebody, and they're negligent. You're going to get sued because they're your employee. Or it could be a debt, either a loan or perhaps a lease where you've rented an office building for 5 years and your business is not doing well, and so now you have this lease that you can't get out of, loans that you can't get out of. And so those are the two big type of issues. When we talk about a liability standpoint, you may face liability for negligence in lawsuits arising out of the business activity, including actions of your employees or actions of the other owners, which could lead to liability. Or it could be some other problem like a product that's a defective product or something of that nature. And debt to creditors, so loans and leases and other type of debt that is racked up by the business. From a tax standpoint, liability, I'm not going to spend much time on that, but basically what I want you to know, we're going to talk about some liability shielding properties of corporations and LLCs. They do provide a layer of liability protection, as I'll get to in a moment. But just so you're aware, from a tax standpoint, if you are the owner, the responsible party for the business, you will still be personally liable for taxes, even if you're set up as a corporation or an LLC. This is particularly true with taxes related to your payroll for your employees. So wages that you pay, withholding for taxes and Social Security and Medicare and Medicaid. If you have a retirement plan for your employees, you're personally liable for all of those deposits that you have to make. And so you can't shield yourself out of paying taxes. There are some tax minimization strategies available by using various business structures. But I just want you to know when I talk about this limitation of liability, it doesn't really apply to taxes. You will still be responsible for those taxes if you're the primary person. All right, so let's get into a little bit more about this limited liability issue. Take a look at the various different structures. Okay, so back to this page here. When I talk about limited liability, I have here unlimited on this side, and then I have this orange line, and then on this side we have either a blend of limited and unlimited for limited partnerships and limited liability partnerships, and then we have full limited liability when we talk about the corporations and the LLC. So what do I mean by that when I say unlimited or limited? So basically, what we're talking about here is a situation, well, let me just diagram it out for you. It makes it a little bit easier. So let's say we have a business, and I'm going to say it's a general partnership, just to begin with. A general partnership, again, is two or more people that are engaged in common activity to make money. That's the basic definition. You're automatically a general partnership anytime you and another person are working together with the intent to make money. And so we'll start with that. So let's say we have a general partnership here and we have two owners. We have general partner 1 and general partner 2. So 50-50 owners, so each own 50%, say. So let's just pretend that this business is a farm, okay? And so the business itself, Green Acres Farms Partnership, has land, has equipment, has inventory, and then money in partnership farm checking account, the business checking account, and maybe a savings account, that kind of thing. And they also have insurance and various other assets, right? So these are the business assets down here that are part of the partnership. And that's what they use, all the equipment, the combines and the tractors and the implements, and then they have inventory in terms of when they harvest the seed, they put it into an elevator and they store it for sale. So they have all these assets. So let's just say altogether they have $1 million of insurance, and let's say they have $2 million of other assets, just for an example. So all combined, they have $3 million basically of assets within the business structure itself. So we have two general partners. Now the general partners have their own personal assets. So you may have a house, you got money in a checking account, you've got a retirement account like an IRA account. And so you have these personal assets that have nothing to do with the business. They're your own assets, and each partner has their own personal assets. So one of the things that you're concerned about in terms of operating a business is if there is a problem and you get sued. So maybe, for example, we have a situation where we have one of our employees is driving the tractor from one field to the next. You see that out here in the valley all the time. And while they're driving down Highway 99W, they don't see a bicycle rider in the bike lane and they run them over with the tractor. Horrible. And the person's horribly injured or killed. So we're going to get sued. That's going to be a big lawsuit. So if we get sued in a general partnership, so let's just say we have a lawsuit, and I'm just going to say, let's say it's $4 million lawsuit because somebody was killed. So we're going to get sued. They win $4 million in the lawsuit. So now they're going to try to collect on that money. So they're going to take all of our assets of the business. The land will be put up for auction. The money in the partnership checking account will be garnished, seized from the bank. The equipment will be sold at an auction. The inventory of grass seed and whatever else we have, all of it's going to get sold. Of course, we have insurance, only $1 million. So all combined, we have $3 million of assets which will be taken. So that's gone. So that leaves $1 million as a deficit. So where is that $1 million going to come from? All of the assets of the business have been seized already, or the insurance is paid out. So in a general partnership, the partners have unlimited liability. And so what that means is if there are insufficient assets within the business to pay those claims, either through a lawsuit or if it's debt, then their personal assets are also at risk. So the people, the plaintiff that filed the lawsuit, they can go collect and potentially take the owner's house and checking account and all their personal stuff, their investments, whatever they own. There's no barrier that is created by the business entity. So that's one of the real big downsides to a general partnership is you don't have any barrier or liability protections that are created by the business entity itself. This is also true in the event that one or another owner does something wrong, and that leads to legal problems of some type. So if this owner, let's say, goes out at lunchtime and goes and has a hamburger and a pitcher of beer, and then they're driving the farm truck, and then they're on their way back to the field and they run over somebody. So that's your partner who just got driving under the influence and now vehicular assault as well. So again, they're in the course and scope of the business activity. The business is also going to get sued for what they did wrong. Now the partner is going to get put in jail and they're going to get sued as well, but the business will also get sued for what this partner did wrong. And so this partner potentially could lose their house for the drunk driving situation. And that's just something you don't want. You don't want to have potential liability if one of your other partners does something wrong. Now that would have to be in the course and scope of the business. If they were, on a weekend and had nothing to do with the business, you wouldn't be liable for that, but you get the point. That's particularly true in a situation let's say it's not farming, but let's say it's a medical clinic. And now we have doctors that are partners in the clinic. So if I'm a doctor, I don't want to be liable for the malpractice of another doctor. That's one thing in farming, but it's a whole other thing if it's medical malpractice or dental malpractice or lawyers or architects or engineers or other types of professionals. You don't want to be liable if you had nothing to do with the surgery, it wasn't your patient, but because it's through the medical clinic, which is a partnership, you don't have any liability protections. So that could be a disaster. So that's one of the main reasons why we really don't like general partnerships. We typically don't try to set up a general partnership on purpose. And the reason I say on purpose is a general partnership, as I've already said, is the default. What that means is it's automatically created unless you have organized in a more formal way. And so even though you don't really think you're a partner, in the law, if you're working with somebody else, you're automatically a partnership. So let me give you an example of how that might happen. Let's say that instead of a farm, now it's a beach house down in Lincoln City. And we have children that inherited the beach house from their parents when their parents passed away. So we have two siblings. Both of their names are on the house deed as 50-50 owners, and they rent it out. Just, you go down to the beach and rent a house, VRBO kind of thing. So both their names are on the deed. They basically split everything equally. They don't really consider themselves a partnership, but for legal purposes, they're a partnership because they're using an asset that they both own to make money. And so if somebody goes to the beach house and gets hurt, maybe there's a rotten board in the back deck and it collapses or something, and they get sued, they're both liable for that because they're a partnership and potentially their personal assets would be at risk. So when we talk about this idea of liability, when I go back to my chart real quick, right here where it says unlimited for sole proprietorship, unlimited for a general partnership. That means there is no barrier, there's no protection to protect your personal assets in the event of a lawsuit or other situation where you don't have enough business assets to cover your debt or lawsuit. There's no barrier whatsoever. So sole proprietorship, general partnership, neither of them provide any liability barrier. Your personal assets are at risk if you are sued or whatever. That's the point I'm making. Now, real world, sole proprietorship, basically, if you're not really doing anything major, maybe you're selling some stuff on eBay here and there, you don't really have any major storefront or major activity, and you don't want to go to the expense and hassle of setting up a more complicated business structure, that's fine. You got to weigh what your liability exposure is. If you're just selling old Legos and stuff on eBay, you don't have a lot of liability exposure. On the other hand, if you're selling food products, you got a lot of liability exposure because if you sold like a peanut butter or something that you made and somebody got E. coli or salmonella from it, you're going to get sued big time. So that's why it's better to set up one of these other formats. All right, so now let's go to the opposite end over here for corporations and LLCs. And you'll notice it says limited. Unlimited over here, limited over here. And I have this orange line down the middle. I put that there, that's the liability protection line. So on this side, these type of organizational formats have at least some level of liability protection. On this side, there's none. So when we talk about corporations and LLCs, both of them have full liability protection to the extent that is allowable. It's not 100% complete. There are ways around it. But let me just kind of show you how that works in a diagram here. So instead of a general partnership now, we have either an LLC, an S Corp, or a C Corp. And for the most part, they're treated the same in terms of liability protection. So now, again, let's say we have two owners. We have owner number 1 and owner number 2, and they're each 50-50 owners. And again, they have their own personal assets, just like before. But now, instead of a general partnership, they're one of the 3 that I have listed here. So again, let's say they have $3 million of assets and insurance, just like before. and there's a lawsuit for $4 million, just like before. Again, the assets that are in the business, the land and the equipment and the corporate checking account and all of that, that's going to be taken, that's gone. The owners will lose their investment in the corporation. But this additional $1 million that remains owing, now when they try to go after the owner's personal assets, there will be a liability barrier here. And so long as they've maintained and properly organized their business structure, that will provide a layer of liability protection to insulate their personal assets from being taken to pay the obligations of the business. So it's kind of like a force field in Star Trek, right? Shields up Scotty kind of thing. The lasers bounce off and the photon torpedoes, because it creates that liability barrier. So the difference between the sole proprietorship and a general partnership is you don't have any liability protection at all. Where here, there is at least a layer that has to be overcome in order to go after the owner's personal assets. Now again, this is not an absolute barrier. There are ways around that, which gets a little bit detailed, more than I want to get into in this class. But just to give you some ideas, one way that this can be overcome is if the owners are commingling their personal assets with business and corporate assets. So maybe the corporation they're using to pay their personal bills, you know, their food and their personal automobile expenses, they're buying their own clothing, they're paying for their vacations, their satellite TV, none of which are business related. It's a personal expense. But they're using the corporate checking account to pay those personal expenses. In that kind of a scenario, a judge in this lawsuit we're talking about can order that because they've been commingling, this barrier can be brought down. And then they can go after the personal assets because it's just it's called a fraudulent transaction. That term is called piercing the corporate veil, which you may have heard about if you've taken other business classes. That's what that refers to, getting through that barrier because they're commingling or misusing the corporate structure. Now that's pretty rare, but it could happen. Another way that that barrier is not absolute is if you're the one that caused the injury. So if this owner was the one driving the tractor, the corporation's still going to get sued. This owner will also be sued personally because they were the ones driving the tractor. So they have personal liability arising out of their own actions. So this barrier will not protect you if you personally are the one that did something wrong. Primarily what you're wanting that barrier for is if you have lawsuits that derive out of the business operations or actions of your employees. But even if this is the owner that did something wrong, their personal assets will be at risk, but there'll be a shield this way. So this owner, personal assets would not be at risk because they were not the one that actually was driving. Does that make sense? You can't escape liability for problems that you yourself caused by setting up a corporation. And there's some other ways to get through that too, which I don't really go into in this class. It's another different class. I just want you to know this basic concept of whether or not there's liability protections and what that liability protection is meant to do, and that's to protect and insulate your personal assets from potential lawsuits and other claims against the company. Okay, so when we look at this line right here, and I'm going to come back to limited partnerships and limited liability partnerships because they're a little bit of a blend. So when we talk about this line right here, unlimited means there's no shield, so that would be the general partnership model. There's no barrier here at all. And then over here where I have full limited, that's where we have this barrier. Now don't worry, I'm not going to make you diagram all this out for the test or anything, Okay, I just want you to know, it's real simple, okay? If you know which ones have unlimited and which ones have limited liability, that's the level of knowledge I want you to have. I'm not going to get into piercing the veil and all that kind of stuff. So I may ask you on the final, hint, hint, what are 4 types of business structures that have at least some liability protection? And the answer would be anything on this side of the orange line. Limited partnership, limited liability partnership, an S corporation, a C corporation, or an LLC. If you have that level of knowledge, that's sufficient for this class. Okay, so now let's talk about taxation issues. And again, I want you to know this line right here, and I want you to know which of the business structures are subject to a double tax, so to speak. That would be a C corporation. And then which are considered what's called a pass-through or a single tax entity, and I'll explain what that means in just a moment. So that's real simple. All of these are a single tax except the corporation that's a C corp. An S corp is single tax. A C corp is double tax. So let me explain what I mean by that. So now we have, let's say, a C corporation. We'll start with that. So a C corporation is a corporation that is subject to pay corporate income tax. A C corporation can have unlimited number of shareholders. It can be organized in very detailed ways. It could even be publicly traded. So Microsoft and Intel and all the big companies that are publicly traded, those are all C corporations. Now, C corporations can also be used in small business. It's not as common in a small business because you have other options available, which are subject to less tax. But it is possible. You could have a one-person corporation. That's legal. In fact, I'm a corporation myself. I'm an S corp in my law practice. And I'll talk about those more in a minute. So let's talk about what I mean by this double tax. So let's say it's a farm, and I'm just going to, for argument's sake, just say we have one owner. We'll keep things simple that way. So here's our farmer down here who owns 100% of the business. So let's say the corporation has gross income of $1 million for the year. So the corporation, the farm brought in $1 million of income from whatever activities, selling crops and doing whatever, livestock or whatever. And the corporation had expenses of, let's say, $900,000. So they brought in $1 million, had $900,000 of expense, which leaves a net of $100,000. Okay? So the way that works, and that's profit. So this $100,000, the C corporation will have to file a corporate tax return. If it's, and on that corporate tax return, they're going to show the $1 million of income, the $900,000 of expense, and the $100,000 of net income, which in tax world is called taxable income. So that'll be filed, it's an 1120 form, which is a corporate tax return, and that'll be filed with the IRS and the State of Oregon Department of Revenue. So on that $100,000, the corporation is going to have to pay tax on that $100,000. So let's just say it's a 20% tax rate. So $20,000 will be paid in corporate tax. Okay? So now that leaves $80,000 in the corporate checking account after tax income. So basically you got $80,000 left after paying the corporate tax. Now we have the farmer down here. The farmer needs to pay their own bills, make money. So the farmer wants to receive that profit distribution. So the farmer will have the $80,000 flow down to the farmer, and then the farmer is going to have to include that $80,000 that they received as the shareholder on their personal income tax return, which is due on April 15th. And they're going to have to pay tax on that $80,000. So let's just say, I'm going to keep it simple. Let's say they're also at a 20% tax rate. So they're going to pay $16,000 in individual tax. Okay? So the corporation pays tax. The individual pays tax on the money they received as the shareholder of the corporation. It's called a dividend, right? So this is what we mean when we say there's a double tax. That same $100,000 is essentially being taxed twice. Once at the corporate business level, and again at the individual level when they receive that profit distribution. Now I'm kind of simplifying things a little bit for this class. In the real world, there are ways to minimize that by not taking all of that money perhaps and holding some of it back and doing some things like that. But I just want you to be this basic concept of a double tax, corporate and individual, all right? So, let's contrast that with the other types of business structures. And I'm going to go here real quick. Pass-through entity. I'm going to abbreviate that PTE, a pass-through entity. So this is a term that we use in tax law that refers to an entity that is not itself subject to income tax as an entity, as a business entity, or as some other kind of entity, perhaps a trust or a nonprofit or something like that, okay? So a pass-through entity basically is a phrase that refers to the idea that the profits of the business pass through down to the owner, or owners if you have more than one owner. And the owner then pays tax on all of the profits. The business itself will not pay an income tax of their own. So let me show you how that works. Again, pass-through entity. Where's my sheet? Oh, there it is. Okay. So this is C corporation. This is not a pass-through. So let's contrast that with an S corporation, which is a pass-through. So now we have the same thing. We have an S corporation. And again, let's say it's a farm, exactly the same. You have $1 million of income, gross income. We have $900,000 of expense. And again, we have $100,000 of net profit. All right, so before, the corporation had to pay tax on that $100,000. But an S-corp, and this is also true of the other entities, is not a taxable entity. You still have to file a tax return. It's called an 1120-S form, which I won't test you on, tax you on, which is due on March 15th, which is coming up here in 2 weeks, right? In fact, I'm working on my tax return today as we speak. So, come March 15th, S corporations have to file their tax return with the IRS and the Department of Revenue. But this tax return is not really a tax return, it's called an information return. And that basically means that you're informing through the tax filing the IRS and the Department of Revenue that you had this income, you had this expense, and that you had $100,000 of profit. That way the IRS and the Department of Revenue for Oregon, they know, okay, when the owner here, again, one owner, and you can have a one-person S corporation, it's very common. So the owner then, on April 15th of each year, will have to file their personal return, which is called the 1040 form. That's your personal income tax return. So on April 15th, the owner will have to report that $100,000. And the 100,000 passes through the business down to the owner. So the owner has to report all of that 100,000 on their personal tax return. And then they will have to pay tax on that amount. So it's probably going to be around a 25% tax rate. Well, there's also state tax, but let's just keep it simple. So that's 25,000 that the owner will pay in tax. Okay? So this is what we mean when we say a pass-through entity. You have the same profit as the C Corp, but that profit flows down to the owner, or if you have more than one owner, that'll be split based on their percentages, and then they'll report whatever their percentage is of that profit. Just so you know, there's a form to report that profit. It's called a K-1 form. If you're into tax stuff, you're going to be an accountant, you'll need to know what that is. It's called a K-1. Don't worry about it for this class. I won't test you on it. That's way up here, MBA level kind of thing. So that's what we're talking about when we say a pass-through entity. It passes through the business down to the owner, and then they pay all the tax with their personal tax return. So the C Corporation, double tax. It's not a pass-through. Tax here, and then again tax at the owner level. An S Corp, and this would also be true for an LLC or any of the other structures, is a pass-through, and all of that profit will be reported on the personal return, and then they'll pay tax on that whole amount of the profit. So when I look at my chart here, when I say single tax, all the way across except for the C Corporation, that's what I'm referring to. I'm referring to this idea of the profits flowing through down to the owners. And then they report that on their individual tax returns. So all of these that have single tax, that's what I mean. The corporation, at least for purposes of this class, is the only entity that has to pay that double tax. Now when I say purposes of this class, the reason why I phrase it that way, in the real world, if you're an LLC, if you want to, you can be taxed as a C corporation and pay corporate tax. It's really rare for that to happen, but there are some times when it makes sense to do that, primarily in real estate or natural resource type like forestry or mining or oil development, where you want to hold money back as what's called a retained earning. That gets way beyond this class, okay? So don't worry about that. For this class, we're going to keep it simple. All of the entities other than the C corporation are pass-through. The money will flow down to the owners, and then they pay tax on their individual tax return based upon whatever their marginal tax rate is that year. So it may be higher percentage if you have more income, or a lower percentage if you have less income. All right? So, test question would be something like true or false. S corporation is subject to double tax. Answer false, right? It's a pass-through single level tax. So that's a real easy one to remember. Only the C corporation is subject to that double tax. If you know that much, again, I'm not going to make you diagram it out or do tax forms or anything like that, right? Those are different classes. We'll just kind of keep it basic. All right. So we'll come back to that here in a few minutes. So next we have formalities, and again, I'm not going to spend a lot of time on that because we have a whole nother class on that very topic. But just so you're aware, when I mean formality, what I'm referring to is the idea of what are the documents that need to be filed with the government in order for you to, first of all, properly set up the business, and what documents do you need to file to keep the business active. And that's basically got to pay a renewal fee every year with the state. So basically the way it works is the more liability protections that you have, the more documents are necessary. The less liability protection that you have, sole proprietorship, the less documents you need. And that kind of makes sense. The more complex, for purposes of liability protection and setting up a corporation or an LLC, or the limited partnership types, the more complexity you have, the more liability protection you have. And it also goes along with the ability to raise money on public markets, which are very document filing intensive. So with a sole proprietorship, there's essentially none. There are really no formalities. You are automatically a sole proprietorship the minute you start doing something to make money. It's as simple as that. However, you may need to file what's called an ABN. This is sometimes called a DBA. That stands for Assumed Business Name. DBA stands for Doing Business As. In Oregon, we say it an ABN, but some states use DBA. Same thing. So let me just talk about that very quickly. Again, I'm not going to get into the uses of them. That's a different class. But essentially, this is the idea that if you are doing business in your name as a sole proprietor or as a general partnership, you really don't need to file anything with the state. So if I'm going to have a hot dog stand and I'm going to call it, Hasbrook's Hot Dogs, I'm using my name as a sole proprietor. So I really don't need to file that. There may be reasons to file it for name protections and things like that. But if I'm just going to go out and start up and do things, I'm using my name and I'm billing under my name and payments are coming to me, John Hasbrook. I can go open a checking account and do all that, use my own social security number if I want to. Not a good idea, but you can. So you don't really need to file anything. But if I'm going to use a different name like Monmouth Super Good Hot Dogs for my food cart, then I'm going to need to register and assume business name because it doesn't have my name in the title of the business. And the reason behind that is that way you can look up, as a matter of public record, who owns a business. The state also looks that up to determine licensing. The banks look that up to determine who has authority to do check writing and that sort of thing. So that's why you have to file an assumed business name if you're doing it in other than your legal name. Same thing with a partnership. Again, I had the idea before of two siblings that own a house together that they're renting out. Their names are on the deed. They're not using a different name like, Cliffside Manor or whatever, rental house. It's just a rental house. So in that case, they don't need to file. But if they're going to be using an assumed business name on an ongoing basis, a trade name, so to speak, a brand name, whatever you want to call it, then they're going to need to register that. Now when I say register, what do I mean? Well, right here, you got to file with the SS. That stands for Secretary of State, which I have on page 81. Filing with the Secretary of State. So the Secretary of State, and this is true in every state, has one of the primary responsibilities of the Secretary of State, among other things, is to maintain records of business activity within a state. And the Secretary of State is where you go to start a business, you register the forms. Again, I'm not going to get into the details of that, that's a different class. But basically, you file your forms with the Secretary of State to start the business. This is true for S Corp, C Corp, LLC, all of them. And that's where you have to renew every year. If you're doing business outside of the state in another state, you'll have to register in that state as well through the Secretary of State in whatever state you're doing business. If you're doing business in all states, you have to register in every state, basically. So I won't get into the intricacies of that, but I just want you to know that that's when I say filing, that's what I mean. Now these are some of the other documents that have to be done for formalities, bylaws for corporation and that kind of thing. Again, I'm not going to get into those in this class, that's entrepreneurship class. or business law 2, we talk about that as well. But these are some of the other forms that you have to file to keep your business, to get it started, and then keep it active every year. Now, if you don't properly file, again, you default back. So if I'm one person and I don't properly file, or I don't maintain my business structure as an S corporation or something, I'll default back to a sole proprietorship. Same thing with multiple people in a business. If you don't file properly, you default to a general partnership. Now, why do I say that? It's important because you may lose your liability protection because you didn't renew your business. So enough on that for this class. All right. So in terms of formalities, with the sole proprietor and general partnership, again, there really are none so long as you're doing business in your own name or a derivative of your name of some type. For all of these other ones, you have to file with the Secretary of State to form the entity of that organizational type. And they have different forms depending on what you're doing. If it's a limited partnership or a limited liability partnership, this is a different form. A corporation, it's the same form for both an S and a C Corp. And for an LLC, it's a different form called Articles of Organization. And again, I'm not going to test you all that. I just want you to know, real basic, to start the business, you got to file with the Secretary of State. If you know that much, file with the SS, you're good. Okay? I'm not going to make you list out what forms you have to do or anything like that, so don't worry about that. Again, that's a different class. So, we're going to skip over financing. So let's go down and start talking about management. And when I'm talking about management, what I mean is, what is the structure and how do the different entities, how is management handled within different entities? So, sole proprietorship, simple. The owner is 100%, right? You're the sole proprietor, you have all the management power. You have the power to write checks, to sign contracts, to enter into credit cards, to sign lease agreements, to obtain insurance, whatever licensing you might need for your business. That's all done by the owner, that's obvious. In a general partnership, all partners can manage, and that's based upon a percentage vote of their partnership allocation. So if you have 50-50 partners, each of them get a vote 50%, and they, as a general partner, have management authority. Now that can be limited by agreement between them, but for purposes of this class, we're not going to get into that, it gets too detailed. I just want you to be aware, in a general partnership, general partners have the ability to manage the business based upon their percentage vote, and that also means that a general partner can sign contracts, like to open a credit card in the name of the partnership, obtain a loan to buy equipment, buy or sell assets, those kind of things. Now the reason why I'm saying that is in these other type of structures, you have different management layers, and owners may not have any management authority at all. That is a possibility. It may be delegated to a board of directors or other type of management structure. So let's start taking a look at the differences and how that works. So I'm going to start here with a limited partnership. Explain kind of how it is structured. So limited partnership is sometimes called, I wrote the word up here, silent partnership. You ever heard that term, silent partner? So the reason why I say that is the idea of a limited partnership is a partnership where you have two different types of partners. One type of partner is the limited partner, and they will be an investor. They're putting money or other assets into the partnership. Their role is a silent partner. And what I mean by that is they will not have any management authority whatsoever. They put money in to the business endeavor, and then they get a percentage return based upon their ownership percentage. Their sole role is that of an investor, putting money in or other assets like land or whatever, and as a result, they then get a percentage of the profit. So the way that a limited partnership works is you have, like I say, two different roles, two different types of partners. So let's say we have a limited partnership that has three limited partners, which are the investors. And I'm just going to say, just as an example, let's say it's an apartment building. So we have an apartment building here, and let's say it's going to cost $3 million to buy this apartment building. And so each partner is going to put in $1 million as an investment into the partnership to purchase that apartment building. And in exchange, they will get a 30% ownership interest. I know that doesn't total to 100, and I'll show you why in just a moment. So the limited partners are investors. They're putting money in to buy this apartment building. They will then receive 30% of the net profit after all your expenses and taxes and maintenance and all that's paid. And if they sell the business or the apartment in the future, they'll get 30% of the net proceeds. Now, in the apartment building, so let's say it's a 20-unit building, we got the apartment down here where the manager lives. Now the investors don't want to manage the apartment. They don't want to collect rents and screen tenants and do repairs, you know, all the stuff that a manager has to do. So they're going to bring in a manager. The manager will be a general partner. That's the manager. And they're going to be allocated, let's say, 10%. So you have two different roles. You have the role of the investor, the limited partners, and you have the role of the manager, which is the general partner. The general partner will have management authority, buy, sell, enter into contracts, debt, you know, when to make repairs, what color to paint the building, screening tenants, all that kind of stuff, right? That's doing the taxes. And then the manager will make the profit distributions each month or quarterly or whatever it may be. So in terms of liability, because it's a limited partnership, the limited partners will have liability protection. So that means if somebody gets hurt and sues because of faulty, you know, maintenance or whatever, they may lose their $1 million investment, but that's the only risk that they have. Their $1 million investment they put in, if they get sued and there's insufficient insurance and other assets, then there's that liability shield there. They may lose their investment, but their personal or other assets are shielded. This is why we call it a silent partnership. The idea is that the limited partners, as investors, put money in. That money is at risk, but they don't have any other risk for their personal assets because they don't have management authority. So what I want you to know about a limited partnership model is you've got these two different roles, the investor role and the manager role. So the limited partners have liability protection, and the reason for that is they give up the ability to manage in exchange for that liability protection. That's the idea. Now the general partner is a whole different thing. The general partner has management authority. Along with that, the general partner will have unlimited liability because the general partner has that management power. And so the idea is if you're in charge, you also have responsibility and obligations. And you are liable if you do not manage properly. So if we get sued for $4 million, they're going to take the apartment building, it's gone. They go after the limited partners, but that shield is there, but they can get the rest of that money from the general partner, the extra $1 million that's still owed. So on my chart, right here, Limited partnership, unlimited liability for the general partner, but limited for the limited partners. Down below, management, the general partner manages, the limited partners may not manage, should say cannot, shall not manage. This is one of the problems with a limited partnership as a form of a business. And what I mean by that is typically, if you're putting $1 million into something, you want to have some control over what goes on, right? I want to make some decisions if I'm putting that kind of money into an apartment. You know, when are we going to put a new roof on? Are we going to paint? What color? All that kind of stuff. But you can't if you're a limited partner. If you do, if you engage in management activity, this liability barrier can be brought down and you can be converted to a general partner by the court, by a judge. And that does sometimes happen. So this is one of the good things and the bad things about a limited partnership in terms of a model. We have investors that do have protection. They may lose their investment, but they have liability protection above and beyond that of their personal or other assets. General partner has unlimited liability. That's a detraction because if you're the general partner, you have, unlimited risk. You may lose your house and everything. So that's one of the downsides to this. Now with that said, limited partnerships have been around a long time. I mean, this goes back to ancient Greece, and really where it came from is maritime law, shipping. So you had a ship, which was the partnership. You had a captain, which was the manager. And then you had investors that would put money into the voyage to buy, to hire crew, buy foodstuffs for the crew, and then to buy cargo when they went to a port. And then when they brought it back to the home port, they would sell it and split the profits. That's where this came from. And the idea was the investors didn't want to have liability for what happened on the ship. If the ship went into port and the sailors went out and destroyed the whole city like some kind of Pirates of the Caribbean kind of thing, you as the investor, you don't want to be liable for that. Yeah, you might lose your ship, but that's the extent of your risk. So bringing it forward to today, we still see this model quite often in other type of areas. So real estate, it's pretty common to have like a shopping center, or you see this a lot in assisted living facilities, in student housing facilities, where you have investors that put money in. They don't want to have anything to do with it. They just want a check every month. And so that's still a pretty common model, although it's shifting now towards LLCs. So all I really want you to know, that gets more detail than you need to know for this class. I just want you to know there's these two roles. You have the general partner role and the limited partner role. If you know that much, you're good. And then they split the profits out based on their percentages. So that's a limited partnership model. And again, there are some problems with it, like I talked about earlier, especially in a family business situation. Like, let's say again, we have, let's say, a family farm. 4 siblings that inherited the farm from their parents, and they all want to be part of, they each own 1/4 of the farm, and they want to be part of the farming activity. The problem is they can't, because then they become a general partner and have unlimited liability. So if they want to have limited liability, they can't be involved in any type of management or other activities, or they lose that protection. So it's not really an ideal form for that kind of a structure. So let's move on. And just so you know, there's kind of an evolution that's going on as we work our way towards LLCs. LLCs are the most recent type of business organization. They've been around since the 1990s. Limited partnership, like I say, they've been around thousands of years in one form or the other. So we're going from sort of oldest to newest, which actually I should flip S Corp and C Corp, because S Corps are newer. All right, limited liability partnership. So this is slightly different than a limited partnership. So in a limited liability partnership, so again, let's say we have an LLP now. So the idea behind a limited liability partnership was to create a type of organizational structure primarily for professional service providers. So doctors, dentists, lawyers, accountants, architects, engineers, insurance agents, real estate potentially. So the idea of a limited liability partnership is the basic idea that you have, let's say, doctors that want to open a medical clinic. So here's our medical clinic. That's a red cross right there. So let's say we have 3 doctors. We have doctor number 1, doctor number 2, and of course we have Dr. Evil. So they're going to open a medical clinic here. So the medical clinic, let's say, same thing, it's going to cost $3 million to buy the clinic, put the equipment in it, all the x-rays and all the stuff, all the machines, hire staff, all the inventory, bandages and drugs and all that kind of stuff, right? So they're going to have a medical clinic. So each of them will put in $1 million to buy the clinic. So they're going to be purposes of the clinic, they're going to be considered a general partner. Okay? So they're each going to have 1/3 share of the clinic. So that means that if they sell the building in the future, they'll each get 1/3 of the sale proceeds. They'll distribute 1/3 of the profits out of the clinic operations to each other. And the idea being that they're going to open a clinic is expensive and it's hard just for one doctor to do that. So that's why they team up together so they can pool their resources and cut down on their overhead and share it among the partners. So the idea of a limited liability partnership, again, is to allow professionals to engage in professional activity together and to have management authority over the clinic. So each doctor will be able to vote on major decisions for the clinic, whether to refinance the loan, whether to buy new equipment, who to hire as an office manager, what kind of billing software to use, all that kind of stuff, right? So they'll each get 1 vote. They're a general partner. Now, as a general partner, the problem is they have unlimited liability in that role. So that means if somebody trips on the stairs coming into the clinic and gets hurt and sues, they are all personally liable above and beyond their investment for anything deriving out of the clinic. So any debt, employee claims, stuff like that. Now that's not great, but at least you can manage that risk as best as possible by having good policy, best practices in how you do maintenance, of course insurance, making sure you have adequate insurance to cover claims. That's not the big risk that you're really worried about as a doctor. What you're worried about is Dr. Evil doing weird stuff and getting sued for malpractice. So this is where we talk about malpractice. So for malpractice purposes, they will be considered limited partners. Now, what do I mean by that? What I mean by that is for any claims that arise as a result of the professional actions of one of the partners, that partner will be sued for malpractice, right? So if Dr. Evil misdiagnoses a disease or doesn't prescribe drugs properly or whatever, and there's a lawsuit for malpractice or they kill somebody during surgery because they're negligent, Dr. Evil's going to get sued. And that's what the other doctors, they don't want to have liability. They're not even involved in the surgery whatsoever. They don't want to have that flow over liability. So a limited liability partnership allows for shielding of the other partners for claims arising out of professional negligence. Not for clinic claims, they all share that, but individual claims. So long as these other 2 doctors didn't have anything to do with the malpractice, the misdiagnosis or the surgery that went bad or whatever, they're insulated from that liability. Does that make sense? So you have two roles. You have the role of a general partner, and then the other hat that you wear is a limited partner hat. So you do have some management authority, but you don't have the liability for the bad actions of the other partners. That's the point I'm making. Now again, that's better than the limited partnership model, because in a limited partnership model, one of the doctors would have to be the managing doctor, and then they have unlimited liability, including for malpractice of the other doctors. So this is a better model than the limited partnership model, but it's still not full liability protection like you get with a corporation or an LLC. Okay, so I want to show you something real quick here before I forget. So we have three types of partnerships: a general partnership, a limited partnership, otherwise known as a